Oh, hello. Welcome back to the continuing lecture in ROI and macroeconomics. This is Dr. Jeff Holm, and this is eighth video, I believe, in this topic. So this topic has been it's actually a very very huge topic, actually, if you think about it. It feels like this topic has been dragging on for quite a while, but it's inevitable because this is a very big topic. It's like, trying to condense the entire a macro monetary theory, macroeconomics monetary theory into a few hours of lecture, and actually, it's like so it's really not that easy to make it as short as possible, or make it as condensed as possible. But I guess like at least two more, right? Or 2 to 3 more videos we'll be able to, I guess, get to the end of this topic. So anyway, we in our last video we discussed the open market operation, and I said open market operation is only one tool out of 3 tools the Federal Reserve has under its control. Now, but open market operation is the most frequently used and most preferred tool because of its pervasive effect. I mean, basically monetary policy by definition is a tool that doesn't require a lengthy process. I mean, it can be implemented easily by the Federal Reserve, and simply by Federal Reserve's policy. In other words, as Federal Reserve simply takes the steps to buy back or sell more treasury securities, which is a market mechanism. In other words, simply they have to release more treasury securities in the market or buy back. So it doesn't take a complex process. Now, and I'm talking about the monetary policy as opposed to the fiscal policy, because there are ways to there are also other ways to stimulate the economy or cool off the economy. And one thing is monetary policy, and the other one is fiscal policy. But the fiscal policy is we don't have time to go into details of the fiscal policy, but the fiscal policy is um, a political process. In other words, um, when we say fiscal, it basically means, it implies tax revenue, right? And spending through the tax revenue, spending from the tax revenue. So it's inevitable. It's inevitable to um, have political debate because increasing or decreasing taxes, or whether to incur uh, debt, uh, deficit spending. I mean, uh, if they don't increase taxes, they will have to uh, increase debt, the government debt, and so all of this, all of these um, uh, discussions, as about raising more taxes, or you know, um, uh, spend with from deficits. It's called deficit spending. They all have to be uh, they they all have to go through the Congress, because taxation, whether to raise, it's the uh, legislative uh, decision of the legislative branch whether to raise taxes, more taxes, or not. So, fiscal policy is a really lengthy political process, and sometimes, it gets nowhere after a very, very long uh, uh, process. Uh, After voting, it may get nowhere. So monetary policy is, compared to fiscal policy, monetary policy is relatively straightforward, and because it's just the decision of the Federal Reserve. An open market operation is the preferred tool, and the second tool is discount rate. So what is the discount rate? And previously, I briefly described it as um, uh, a last resort um, when commercial banks cannot borrow from Fed funds market, right? In other words, if they borrow from Fed funds market, that's through the Fed funds market, right? That's basically borrowing from another commercial bank. But if they cannot borrow from each other anymore, then as a last resort, they will have to come to the Federal Reserve. And I said, it's just a metaphor. It's just a figurative expression, because they're not really borrowing from the Federal Reserve. It just is described that way, but it's not really like, Federal Reserve is lending uh, to the commercial bank. Because think about it, Federal Reserve, what is the source of funds for the Federal Reserve? I mean, Federal Reserve isn't taking deposit from the Federal Reserve isn't like commercial banks. They are not taking deposit from people like you and me. I mean, you has anybody ever heard of anyone making a deposit with the Federal Reserve or borrowing money from the Federal Reserve? No, not at all. Federal Reserve is the uh, bank of the banks. So, in other words, what that means is so where does the Federal Reserve? I mean, if it is a bank, uh, where does its reserve come from? In other words, the reserve, right, which is the deposit. Well, actually, it comes from the commercial banks. Commercial banks uh, voluntarily make um, uh, deposits with the Federal Reserve. But this is not like something that um, the Federal Reserve uses to uh, make a lending. Uh, I mean, it's literally the reserve in case some commercial bank is in desperate need for funds. Okay, that's in that sense, funds. But then the lending doesn't happen like the lending in the retail banking. So you can think of it this way. Why? And if Federal Reserve lends to the commercial bank, they charge discount rate. I mean, this is once again, this is a metaphor. If they charge interest, if the interest rate they charge, I mean, if they charge interest rate to the commercial bank, why is it called discount rate? Why? Hmm? Isn't it interest rate? Why do they call it discount rate? So it works actually like this. When the commercial banks um, uh, cannot borrow from each other, then what do? As I said, they come to the Federal Reserve, but um, they don't just come to the Federal Reserve asking for money. What they do is they come to the Federal Reserve with the assets they are holding. The assets mean, they're um, the bonds that they are holding, um, and most of the times, it's usually it's the treasury securities that they are holding, but they can also come to the federal. They can also bring the corporate bonds that they are holding, right? So these are debt instruments, and whoever is holding it has claim uh, to the payment. But anyway, the point is, the bank is when the commercial banks bring these assets they are holding, um, and they are selling it they come to the Federal Reserve with the intent to sell it to the Federal Reserve. But this is not a permanent sale. I mean, think about it. If I'm a commercial bank and I'm holding like corporate bonds, um, in the amount of like $10 billion, and these corporate bonds are paying 10%. 10% of $10 billion is 1 billion, and why would I be, giving it up? I mean, by selling it, I may get the money. I may get $10 billion, but I'm giving up my claim to the interest of 1 billion, right? So as a commercial bank, I wouldn't deliberately do that. So the point is, it may sound like the analogy I just thought about. I just thought of an analogy, but that I will tell you that later. Um, So what they do is, they sell this to the Federal Reserve with the promise to buy it back, right? With the promise to buy it back. So that's why it's called, repurchase agreement. Repurchase, uh, also uh, also shortened as repo agreement. Repo. So repo sometimes sounds like repossess, right? Uh, but in this context, it means repurchase, repo agreement. So Federal Reserve pays money, uh, but the commercial bank will buy back. But give when they pay out money, they don't pay out the face value of these assets, right? Makes sense? Uh, they they discount it. I mean, if the face value is $10 billion, they discount it, right? Maybe like 5%. discount. So then the commercial banks will get, $9.5 billion, but then they will pay it back, like, in short term, like, within a week or within 3 days. Because the reason they are coming to the Federal Reserve is because most likely their funds are lacking, just short run, like overnight or for a few days. So this repo market operation uh, uh, is, the discount rate is basically, like the interest um, the commercial banks pay to the Federal Reserve, right? So think about it. When so they got the commercial banks got, the money from the Federal Reserve, and what do they need it for? They may be lending that for short term as well. So the point is, if commercial bank has to pay 5%, right? It's actually, if you think about it, discount rate of 5% is, in terms of uh, interest rate, it's greater than 5%. Why? Because they pay 0.5 billion to uh, borrow 9.5 billion. Isn't that right? And they pay back, uh, you know, uh, so if they pay 0.5 billion to borrow 9.5 billion, right? And if you work out the number, 0.5 or 9.5, I mean, zero point 0.5 over 10 billion would be 5%, right? But zero point 0.5 over 9.5 is greater than 5%. So anyway, the idea is, if they pay 5% interest, then when they lend it, the commercial banks lend it, they will have to charge a higher rate than 5%. Make sense? Okay. So when Federal Reserve raises this discount rate, then all the interest rates will have to go up as well. But when Federal Reserve lowers this discount rate, then all the interest rates can go down. So this is another way. And there's also something called reserve ratio. What is the reserve ratio? Reserve ratio is, let me explain it to you this way. I mean, a definition is the fraction of the reserve in the checking balance that all commercial banks must maintain to prevent lending beyond the safety threshold. So to explain this, let me use, I will need to use the whiteboard. So, okay, so you see this whiteboard? And let me try, I hope, uh, oh, that's okay, this is good. So what's the, let's look at the balance sheet of the commercial banks, okay? This looks horrible. Okay, commercial banks now, if you think, let's say one commercial bank has, $1 billion, right? $1 billion. But $1 billion come from, mostly, where does it come from? It comes from the depositors, right? It's $1 billion is basically coming from the customers. So Uh, Out of $1 billion, let's say um, uh, checking savers, customers' deposits fall into two categories, right? Checking account balance and savings account balance, right? Now, suppose the checking for checking they have uh, 300 million, right? And in savings balance, they have another 300. Yeah, 300 million, right? And then they have their own equity. What does that mean? When the bank started out, uh, how does the bank start out? I mean, how does any business start out? You have, for any business to start out, you have to have startup capital, isn't it right? And the startup capital comes from whom? The initial investors, so initial shareholders, in other words, so in this bank, when they started out, there were, let's say, uh, 10 initial investors, right? They got together and they chipped in $400 million. Okay, $400 million. So if there were 10 people, right, 10 uh, initial investors, right, each individual, let's say, chipped in, $40 million, right? So with altogether, 400 million. So their total assets is 1 billion, right? But out of this 1 billion, right, checking and saving are actually liabilities, isn't it right? Uh, 400 million is their equity. Uh, so they can loan with their equity, right? They can loan out theoretically 100% of this because it's their own money. They can do you know, um, whatever they want with their own money, right? Uh, and if they have investment opportunity, let's say lending opportunity, where they can earn 10% on in return, then they are tempted. I mean, the higher this return, they are tempted to max out, right? They are tempted to max out on uh, the loan. They want to loan out the maximum. Why wouldn't they? Because 10% of 400 million will be 40 million. There's no reason they would refuse that. Of course, if they are uh, risk avert, right? Uh, they are not going to lend out the entire 400 million. But if hypothetically, if they are willing to um, go all the way. They're willing to go all the way to loan out, to take the maximum risk to get the maximum return. They can loan out 100% of this, right? Now, as for the checking and savings, um, this is the liability. I mean, it's the customer's money. But what's the What's the purpose of, what's the business of banking? The business of banking is in lending. I told you this. I've been telling you. So, so they are tempted to loan out the maximum, 100% of this, right? They are tempted to loan out. But the problem is, okay, savings, savings, the money in the savings is uh, basically tied up. Suppose you put $300 million in a CD, and the CD has contract period. Usually, it could be 6 months, 1 year, 2 years. And suppose your money is all $300 million all in a CD, 2 year CD, or 5 year CD. What does that mean? This money is not going to be withdrawn until the end of the contract or the maturity. So for the next 2 years, um, the bank has um, uh, confidence. I mean, uh, the bank has a guarantee that this money won't be withdrawn anytime soon, not until 2 years left. So they can commit to a long-term lending, right? They can commit to a long-term lending, and of course they will, assuming that they will lend to the highest credit worthy customer, right? And they won't default. Um, High quality borrower like prime borrower, like with AAA rating, right? AAA credit rating. Um, so then they can make 10% easily out of this, right? What about this? They are checking account. They are tempted also, if the bank is a risk taker, right? Uh, they are tempted to loan out 100%. But the problem is, checking account is not uh, checking balance is not locked in, right? The checking When you have a checking account, you can withdraw. The purpose is, to withdraw money anytime you want, and you write checks, every day, and the check comes back for clearing, right? The check comes in for clearing to this bank, so the bank has to maintain um, certain level of balance, right, for checks coming in for clearing, and also for the ATM withdrawals. Make sense? So technically, they cannot loan out 100%. Um, but they are tempted to loan out the maximum if possible. And most banks have if they happen in business, if they happen around for a couple of years, they know what is the average level of reserve they have to keep in the bank. Because what is the average amount of checks coming in for clearing? What is the average level of monthly, right? And let's say per month, what is the average amount of checks coming in for clearing, and what is the average, amount of withdrawal? And if they have this, average, and they will add, something like, 10% or 20% of above that average, and retain they will retain only as much as that amount in the bank, and then loan out the rest, right? But that's quite a rational thinking. But how much? Sometimes, even if they retain the average uh, level of reserve, even plus 10 or 20%, right, above that, sometimes that may not be enough, especially when there is a sudden, unexpected financial crisis, and people run to the bank to withdraw their money, right? And for example, if 3 million is 3 million is average level, right? Monthly 3 million is enough for check clearance and ATM withdrawal. But um, when there is a some economic crisis, then people all run to the bank. 3 million is not enough, right? And if they don't have money to, so then they will ask another bank through the Fed fund system. They will check with another bank for uh, possibility of borrowing. But if there is an economic crisis, this situation is not unique with this bank only. Think about it; it's universal. All the other banks will also face this shortage, right, in fund. And what's going to happen? Bank failure, right? They will, uh, the banks will go bankrupt, right? Uh, Theoretically, right? Of course, in reality, because of the FDIC, the insurance for the banks, right? Uh, the bank, if that happens, then they will, use that FDIC. Of course, that was the worst case scenario, and then you will get your money, but this is called bank run when everybody runs to the bank to withdraw their money, and the banks will default. To prevent this, they um, legislated a law uh, or called fractional banking, um, which is basically saying that all the banks must retain uh, 10% of the checking balance. 10%. 10% would be 30 million, right? That 10% is called the reserve ratio, right? And the 30 million is required reserve. Okay? Um, and this is called fractional banking because a fraction fraction of the checking account has to be retained in the bank. Now, think about it. Reserve ratio applies only to the checking account. It doesn't apply to savings or the equity of the original uh, founding members, right? And but the banks are tempted to lend even beyond. Uh, so that means if reserve ratio is 10%, lend theoretically up to 90% of the checking, right? But if the average uh, amount of checks coming in for clearing and ATM withdrawal per month is 3 million, right? Then the bank is even tempted to lend beyond 90%. They want to even dabble with 95% or 99%. But then that's that's uh, uh, breach of this law. They are violating the law, right? It's a serious offense, serious uh, uh, but think about it. So all the banks stick to the reserve ratio, and think about it. If this reserve ratio goes up, uh, what's going to happen to the money supply throughout the economy? It's very mechanical. If reserve ratio goes up, there will be less money to lend. So the money supply in the economy would go down. If this reserve ratio goes down, the money supply, there will be more money that can be loaned out uh, to the economy, right? There will be more money supply. So currently in the U.S. economy, the reserve ratio is 10%. Suppose it goes up to 20%, of course, money supply will go down, right? Now, so let me sum up, right? Let me summarize everything. So if I, so let's take a look at this. It takes a lot of time. I mean, just to explain, these two, it took 30 minutes to explain discount rate and reserve ratio. But the bottom line is, think about it. When the risk-free return goes up, right? Money supply, interest rate goes up, money supply goes down. Risk-free return goes down, uh, interest rate goes down, money supply goes up. Discount rate goes up, money supply goes down, right? Discount rate goes down, money supply goes up. Reserve ratio goes up, money supply goes down. Reserve ratio goes down, uh, money supply goes up. So the inverse relationship holds through and through. Inverse relationship between the interest rate, bond price, and money supply, right? They all it holds through and through. Alrighty, so that's it for this video. I will see you guys in the next video. Okay, stop recording.